Okay, let's unpack this. You know how sometimes understanding your money feels like trying to read a treasure map written in some kind of secret code? Well, today we're grabbing our shovels, metaphorically speaking, and diving deep into that sometimes intimidating but wow, incredibly important world of personal financial planning.
That's right. And our mission here really is to dig up the most crucial nuggets, the key insights from all that, financial jargon and the complex rules.
Yeah.
We're going to explore basically everything from building retirement savings and choosing smart investments on the way to understanding insurance and planning your legacy. The goal is just to simplify these often complex ideas so you can walk away feeling well-informed and, I think most importantly, empowered. Empowered to make confident financial decisions for your own future.
Absolutely. Empowered is the key word.
Yeah.
So let's start with building that financial foundation, retirement plans. When we talk about qualified retirement plans, what are we really talking about? These are powerful tools, right? They offer some fantastic advantages.
Oh, definitely.
Think of perks like contributions that might reduce your current taxes, maybe earnings that grow tax-free until you withdraw them, and even protection for your money from creditors in many cases. Plus, they can often help you avoid probate.
Right. Probate being that formal, sometimes lengthy, and often expensive legal process when someone passes away.
Exactly. Avoiding that is a big plus.
It is. The upsides are significant. But, like anything powerful, there are trade-offs you absolutely need to be aware of. For instance, the money you eventually take out from these traditional plans, it's typically taxed as ordinary income, not those potentially lower capital gains rates you hear about.
Ah, okay. Good distinction.
Yeah. And also, this money isn't meant for quick access. It's really designed for long-term savings, so it's not very liquid.
Mm-hmm.
And yes, if you touch it too early, before a certain age, there are usually penalties. Though we'll definitely cover some key exceptions to that rule.
Okay. So when we look at the plans employers offer, they generally fall into two broad groups, right? Defined benefit plans and defined contribution plans. What's the fundamental difference listeners should really grasp there?
The core difference, and this is crucial, it's all about who carries the investment risk.
Yeah.
In a defined benefit plan, which people often call a pension, your employer promises you a specific benefit amount at retirement, like a fixed monthly payment. They bear the investment risk. It's their job to make sure the money's there.
Okay. So they guarantee the payout.
Pretty much, yeah. Now, with a defined contribution plan, like the common 401k,
Yeah.
the contributions are defined, maybe what you put in, what they match. But you, the employee, you bear the investment risk. Your final retirement benefit depends entirely on how your investments perform in the market.
That's a huge shift in responsibility.
It's a fundamental shift, absolutely.
Okay, let's really dig into Section 401k plans then, because they are so common. With these, you contribute a portion of your salary, right? And here's a massive point, one that can literally put more money in your pocket. Employer match.
Yes, the match.
We're talking dollar for dollar sometimes, up to a certain percentage of your salary. If your employer offers a match, taking full advantage of it. I mean, it's like getting free money for retirement.
It really is. Not taking the full match is leaving money on the table. It's critical, truly.
So do that. Now, 401ks typically come in two main flavors, traditional and Roth. What's the key difference in how they affect our taxes?
Right. It all boils down to when you get the tax break. With a traditional 401k, your contributions go in pre-tax.
Meaning?
Meaning you don't pay income tax on that money now.
Yeah.
It lowers your current taxable income. But then when you retire and take distributions, all of it, your contributions and the earnings, is fully taxable as ordinary income.
Okay, save now, pay later.
Exactly. And now for a Roth 401k, it's the opposite. You contribute money after taxes have already been paid on it.
So no upfront tax break.
Correct. But the huge potential benefit is that qualified distributions in retirement, both your principal and all the earnings, can be completely tax-free.
Wow, okay. So pay taxes now, potentially save a lot later.
Precisely. It's that kind of trade-off you need to consider based on your own situation.
And when we're thinking about how much we can actually put in, what are the contribution limits generally like? Do they change?
Yeah, they do tend to change each year, indexed for inflation usually.
Yeah.
But for example, back in 2023, employees could contribute, a pretty significant amount, $22,500. And that limit goes up if you're 50 or older. There's a catch-up contribution. For 2023, that was an extra $7,500, bringing it to $30,000.
Okay, good to know about the catch-up.
Definitely. And remember, that employer match contribution, that doesn't count against your limit. There's a much higher overall limit for the combined employee and employer contributions. For 2023, that was $66,000 or $73,500 if you were 50 plus.
Gotcha. And for those Roth 401k distributions to be tax-free, what are the rules again?
Generally, two main things. First, you usually need to be at least 59 and a half years old. Second, the account needs to have been open for at least 5 years. That 5-year clock starts on January 1st of the year you made your first Roth contribution.
5 years and 59 and a half. Okay. But what if life happens and you need that money early? Is there a big penalty?
Typically, yes. There's generally a 10% penalty tax on distributions taken before age 59 and a half, on top of any regular income tax due.
Ouch.
It can be. However, there are some really crucial exceptions. Things like significant medical expenses exceeding a certain percentage of your income, or if you become totally and permanently disabled. Also, distributions made after your death or for the birth or adoption of a child up to a certain limit. And a key one, if you separate from service with that employer in or after the year you turn 55, you can often take penalty-free withdrawals from that specific 401k.
Okay, so 55 if you leave that job. That's different from 59 and a half.
It is. It's specific to separating from service. Just remember, these exceptions are designed for specific, often challenging situations. They're not loopholes for casual early access.
Right. And a quick point on rollovers. If you leave a job, you get this lump sum option.
Yes, rollovers are very important. If you take a lump sum distribution, you generally have 60 days to roll that money into another qualified retirement plan, like an IRA or your new employer's 401k. If you do that direct rollover or manage it within the 60 days, you avoid immediate taxes and penalties, and your retirement savings keep growing tax-deferred. Miss that window, and it can be a costly mistake.
Okay, 60-day rule. Got it.
And then there's the other end of the timeline. Required minimum distributions, or RMDs.
Why, yes, RMDs. The government wants its tax money eventually.
Basically, yes. For traditional accounts like 401ks and traditional IRAs, you must start taking mandatory withdrawals. Generally, the deadline is April 1st of the year after the year you reach age 73, or sometimes after you terminate employment with that plan sponsor, if later.
Then what if you don't take them?
The penalty is severe. It used to be 50%, but now it's at still very hefty 25% of the amount you should have withdrawn but didn't.
25%. Wow.
Yeah, it can potentially be reduced to 10% if you correct the mistake within a certain time frame, but honestly, it's best just to avoid it altogether by taking your RMDs on time.
Definitely something to plan for. Okay, let's shift now to individual retirement accounts, or IRAs. These are personal, right? Not tied to an employer.
Correct. These are tax-advantaged savings accounts that you, as an individual, fund with earned income. Like 401k, the money inside generally grows tax-deferred. The annual contribution limits are set by the IRS each year. For 2023, it was $6,500 or $7,500 if you're 50 or older, thanks to a $1,000 catch-up. These limits apply across all your IRAs, traditional and Roth combined.
And earned income is key here. What counts?
Right. Earned income is generally things like your salary, wages, commissions, tips, bonuses, or self-employment income. Things that typically don't count are investment income, like interest and dividends, or pension income, rental income, that kind of thing. You need earned income in the year you contribute.
Okay. Now, deducting contributions to a traditional IRA, this can get tricky, can't it?
It can get a bit nuanced, yes. The main thing is, if you or your spouse, if you're married, filing jointly, are also covered by a retirement plan at work, like a 401k or a pension, then your ability to deduct your traditional IRA contributions starts to phase out once your adjusted gross income, or AGI, goes above a certain level set by the IRS each year.
Phase out, so it's not all or nothing.
Exactly. There are income ranges. If your AGI is below the range, you get the full deduction. If it's within the range, you get a partial deduction. If it's above the range, you get no deduction.
Right.
Let's take Christy's example. She's 40, single, her AGI is $75,000, and she is active in her employer's 401k. Let's say the phase-out range for her filing status starts at $73,000 and ends at $83,000. Since her $75,000 AGI falls within that $10,000 range, she can only deduct a portion of her maximum $6,500 contribution. The calculation shows she can deduct $5,200. The remaining $1,300 is a non-deductible contribution.
So she still makes the contribution, but only part of it reduces her taxes now.
Precisely. It's important to track those non-deductible contributions because you won't pay tax on them again when you withdraw them later. But the earnings will still be taxed.
Got it. Now, what about Roth IRAs? Contributions aren't deductible at all, right?
Correct. Roth IRA contributions are never deductible. You contribute money that you've already paid taxes on. However, your ability to contribute directly to a Roth IRA is also limited by your income, specifically your modified AGI or MANGI. There are phase-out ranges here too, different from the traditional IRA deduction phase-outs. If your MGI is too high, you might not be eligible to contribute to a Roth IRA directly for that year.
Okay, so income limits affect both, but in different ways deduction for traditional eligibility for Roth.
Exactly. And the big draw for the Roth, despite no upfront deduction, is that potential for tax-free growth and, crucially, tax-free qualified withdrawals later on.
Let's really clarify how IRA distributions work, because this is where that traditional versus Roth difference seems huge.
It really is. Let's break it down.
Yeah.
For a traditional IRA, if you deducted all your contributions up front, then it's simple. Both your principal, the contributions, and all your earnings are fully taxable as ordinary income when you take qualified distributions in retirement.
Okay, taxable.
If your traditional IRA contributions were non-deductible, like Christie's $1,300, then that portion of your principal comes out tax-free. But the earnings portion of your distribution is always taxable. The IRS has a specific way to calculate the ratio of non-taxable principal to taxable earnings in each withdrawal.
So you need good records of non-deductible contributions.
Absolutely essential. Now, for a Roth IRA, your principal contributions, the money you put in after tax, are never taxable when withdrawn, ever. You already paid tax on it.
Okay, that's clear. Principal is always tax-free.
Right. The earnings are only taxable if it's a non-qualified distribution. To be qualified, remember those rules. Account open at least 5 years, and you meet one of the conditions like being 59 and a half, disabled, using it for a first-time home purchase, up to $10 K lifetime, or it's paid to a beneficiary after death.
So if it's qualified, both principal A and D earnings are tax-free. If non-qualified, principal is still tax-free, but earnings are taxed.
Exactly, and potentially subject to the 10% penalty if you're under 59 and a half and don't meet another exception.
Okay, let's use Sally's example to really hammer this home. She's 55, put $5,000 into an IRA, it grew to $8,000. She withdraws $6,000. How is that $6,000 taxed in different scenarios?
Okay, scenario 1, traditional IRA, fully deducted contribution. Since it was all pre-tax money going in, the withdrawal's fully taxable. That full $6,000 is taxable ordinary income. Plus, since she's only 55, she likely owes the 10% penalty on that $6,000 unless an exception applies.
Ouch. Okay, scenario 2. Traditional IRA non-deducted contribution. Let's say that initial $5,000 was non-deductible. Now what?
Now we need that ratio. Her total account is $8,000, of which $5,000 or 62.5% is non-taxable basis, and $3,000 or 37.5% is taxable earnings. So of her $6,000 withdrawal, 62.5%, $3,750 is a tax-free return of her contribution, and 37.5%, $2,250 is taxable earnings. She also likely owe the 10% penalty on the $2,250 taxable portion.
Better, but still taxed on earnings and penalized. Scenario 3. Roth IRA withdrew after 4 years. This is not qualified, right? Because it's less than 5 years.
Correct. Under Roth rules, withdrawals are considered to come from contributions first, then earnings. So her $6,000 withdrawal consists of her entire $5,000 contribution, which is always tax-free, and $1,000 of earnings. Since it's non-qualified, that $1,000 in earnings is taxable, and she'd likely owe the 10% penalty just on that $1,000.
Interesting. Contributions out first. Much less tax than the traditional non-deductible scenario.
Okay, now it's a qualified distribution. The fantastic news here, the entire $6,000 withdrawal is completely tax-free and penalty-free. Zero tax impact.
Wow. That really shows the power of the Roth for qualified distributions. The difference is huge.
It can be enormous, especially over a long retirement.
And penalties for early IRA withdrawals, similar exceptions to 401ks.
Similar, but with some key differences to know. IRAs have exceptions for things like paying for health insurance premiums while unemployed, certain higher education expenses for you or family members, and that first-time homebuyer exception up to $10,000. These are not typically exceptions for 401ks, so the rules aren't identical.
Good to know. Always check the specifics for the account type. And RMDs for traditional IRAs, same as 401k.
Pretty much the same rule. RMDs generally start by April 1 of the year after you turn 73, based on your account balance and life expectancy. And that same significant 25% or 10% penalty applies if you fail to take them.
But here's a big difference for Roth IRAs.
Yes. This is a unique and very popular advantage. Roth IRAs have no RMDs for the original owner. You are never required to take money out during your lifetime. You can let it grow tax-free indefinitely, or pass the entire untouched balance to your beneficiaries, often tax-free for them too, depending on inheritance rules.
That's a major planning advantage. No forced withdrawals.
Huge.
What about folks who are self-employed? Are there special plans for them?
Yes, definitely. There are several options like SEP IRAs, Simplified Employee Pension, Simple IRAs, Savings Incentive Match Plan for employees, and solo 401ks, also called individual 401ks. These plans often allow for much higher contribution limits than traditional Roth IRAs, making them great for business owners trying to save aggressively. And a relatively recent change, starting in 2023, is that many of these self-employed plans, like SEPs and Simples, can now also be designated as Roth, offering that future tax-free benefit. Solo 401ks could already have a Roth component.
So more Roth options opening up. That's good.
It provides more flexibility, definitely.
Let's talk about another strategy, Roth conversions. What's involved there?
A Roth conversion is when you take funds from a traditional pre-tax retirement account, like a traditional IRA or a traditional 401k, and move them into a Roth IRA or Roth 401k.
Why would someone do that?
The main reason is to get tax-free withdrawals in retirement. But here's the catch. The entire amount you convert is treated as taxable ordinary income in the year you do the conversion.
So you pay the taxes now instead of
So
later.
exactly. You're essentially prepaying the taxes on that money. But
Yeah.
here's a key benefit. Unlike direct Roth contributions, there are generally no income limits, AGI restrictions, on doing a Roth conversion. And the amount you can convert isn't limited by the annual contribution caps.
So even high-income earners who can't contribute directly to a Roth IRA can still do a Roth conversion.
Correct. It's often called a backdoor Roth IRA strategy when done with IRAs. It's a powerful tool if you believe your tax rate will be higher in the future, or if you just want the certainty of tax-free income later.
Interesting. Okay, one more retirement-related vehicle, annuities. What role do they play?
Annuities are essentially contracts with an insurance company. You pay premiums, either a lump sum or over time, and in return, the insurance company promises to make payments back to you, either for a set period or for your lifetime. Like other retirement accounts, earnings inside an annuity generally grow tax-deferred.
Are there different kinds?
Yes. Broadly, two main types based on when payments start. Immediate annuities,
Yeah.
you pay a single premium, and payouts begin almost right away, usually within a year. Deferred annuities. You contribute over time, the accumulation phase, and payouts begin much later, typically at retirement, the payout or annuitization phase. Within deferred annuities, you also have different types based on how the money grows. Fixed, guaranteed interest rate; variable, invested in market sub-accounts, returns vary; and equity indexed, returns linked to a market index, often with some downside protection, but also caps on upside.
Okay. And how are the payments taxed when you start receiving them? Is it all taxable?
Not usually. Each payment you receive from an annuitized contract is typically considered partly a tax-free return of your original investment, your basis, and partly taxable earnings. The insurance company calculates an exclusion ratio to determine the non-taxable portion of each payment. For example, let's look at Zoe. She invested $60,000 and will get $750 a month for exactly 120 months, 10 years. Her total expected return is $90,000. 750 by 1 to 20.
Okay.
Her $60,000 investment is 66.7% of the total expected return, 60K, 90K. So 66.7% of each $750 payment, which is $500.25, is considered a tax-free return of her principal. The rest, $249.75, is taxable earnings each month.
So it spreads the tax-free return over the payment period. What about a life annuity where payments last for your lifetime? You don't know the total payout.
Right. For life annuities, the IRS provides standard life expectancy tables. You use the factor for your age when payments start to determine the expected return, and then calculate the exclusion amount per payment based on your investment. Let's say John, age 64, invests $60,000 for a life annuity paying $600 a month. The IRS table might give him an expected return factor that translates to, say, $230.77 per month being tax-free return of principal. The remaining $369.23 would be taxable earnings.
What if he lives longer than the IRS life expectancy?
Once he has received back his entire $60,000 investment tax-free, any further payments become fully taxable. If he dies sooner than expected, any unrecovered investment basis can usually be deducted on his final tax return.
Got it. Spreading the basis recovery over life expectancy. Okay, so we've covered 401ks, IRAs, annuities. With all these options, how do you actually choose the right retirement plan for you? It feels a bit overwhelming.
It can feel that way, but often the most crucial factor in deciding between, say, a traditional versus a Roth account comes down to one key question. What do you expect your marginal income tax rate to be now versus in the future when you withdraw the money?
Okay, current versus future tax rate. Explain that.
Well, the general rule of thumb is, if you expect to be in a higher tax bracket in retirement than you are now, a Roth account often makes more sense. Pay the taxes now at your current, lower rate, and enjoy tax-free withdrawals later when your rate would have been higher.
Makes sense.
Conversely, if you're in your peak earning years now and expect your income, and thus your tax rate, to be lower in retirement, then a traditional account might be better. Take the tax deduction now when your rate is high, and pay taxes on withdrawals later at your anticipated lower rate.
So it's a calculated bet on future tax rates and your own income trajectory.
It really is. Of course, factors like the employer match, income limits for contributions or deductions, and desire for tax diversification also play a role. Let's look at Paul Smith's situation. He's 55, single, high AGI, wants to contribute $15,000. His employer matches dollar for dollar up to $10,000. He's eligible for both traditional and Roth 401k, but his high AGI means he can't contribute directly to a Roth IRA or deduct a traditional IRA. He thinks current tax rates are historically low and will likely be higher in the future.
Okay, high income, expects higher taxes later, great employer match. What's his play?
For Paul, the best strategy is likely contributing all $15,000 to his Roth 401k. Why? First, he absolutely must contribute at least $10,000 to get that full free $10,000 match from his employer. That's non-negotiable.
Great, free money.
Second, since he expects future tax rates to be higher, paying the taxes on his contributions now via the Roth makes sense. This locks in tax-free growth and tax-free withdrawals later, shielding him from those potentially higher future rates. Even though his AGI is too high for a direct Roth IRA, the 401k doesn't have those same income contribution limits. So he uses the Roth 401k to get his money into a Roth vehicle while maximizing that crucial employer match.
That's a great illustration of how you combine the rules, the match, and your tax outlook to make the best choice.
Exactly. It's about using the available tools strategically based on your specific circumstances.
Okay, fantastic. Now, let's pivot slightly. We've talked about saving and growing money, but where does that growth happen in the investment world? And a fundamental truth here is all investments carry risk. You can't avoid it entirely.
That's absolutely correct. And generally speaking, the greater the risk you're willing to take, the greater the potential return you might achieve. It's often called the risk-return trade-off.
So how do we think about these risks? Are there different kinds?
Yes, we can broadly categorize investment risk into two primary types. First, there's non-systematic risk, sometimes called business risk or specific risk. This is risk that is unique to a particular company, industry, or security. Think about things like poor management decisions at a company, a lawsuit against them, or maybe a new regulation that only affects one industry.
Okay, company-specific stuff.
Exactly. And the good news about non-systematic risk is that it can be significantly reduced or mitigated through diversification. Meaning by spreading your investments across many different companies, industries, asset classes, and even geographic regions, you reduce the impact if any single one of them performs poorly. Don't put all your eggs in one basket, basically.
Got it. Diversify away the company-specific risk. What's the other type?
The second type is systematic risk, often called market risk. This is risk that affects the entire market or a large segment of the economy. It's driven by broad economic, political, or social factors.
And can you diversify this away?
Unfortunately, no. Systematic risk cannot be effectively eliminated through diversification alone because it impacts almost all investments to some degree.
Examples.
Think about things like interest rate risk, how changes in rates affect bond prices, for instance. Inflation risk, the risk that rising prices erode the purchasing power of your returns. Currency risk for international investments, or major geopolitical events or recessions. These are systematic risks.
So you manage non-systematic risk with diversification, but systematic risk needs other strategies, maybe.
Potentially, yes. Things like asset allocation, hedging strategies using derivatives, or maybe short selling can be used to manage or potentially profit from systematic risk, but you can't simply diversify it away like you can with non-systematic risk.
Okay, that distinction is really important. Now let's touch on some basic investment vehicles people use. First up, equity securities or stocks.
Right. When you buy shares of stock, you're literally buying a small piece of ownership equity in that company. As an owner, you have the potential to benefit if the company does well, perhaps through stock price appreciation or receiving dividends, which are portions of the company's profits paid out to shareholders.
But there's a downside, too.
Absolutely. If the company performs poorly or goes bankrupt, the stock price can fall, and you could potentially lose your entire investment. That's the risk side of equity.
Okay. What about bonds? How are they different?
Bonds are fundamentally different. They represent debt, not ownership. When you buy a bond, you're essentially lending money to the issuer, which could be a corporation a municipality, like a city or state, or the federal government. In return for your loan, the issuer typically promises to pay you periodic interest payments over a set term, and then return your original principal amount, the face value of the bond, at maturity.
So it's more like an IOU with interest.
Exactly. We often distinguish between corporate bonds, issued by companies, and municipal bonds, or munis, issued by state and local governments. A key difference is taxation. Interest earned from corporate bonds is generally taxable at both the federal and state levels.
Okay. And munis.
Interest from municipal bonds is typically exempt from federal income tax. And if you buy munis issued within your own state of residence, the interest is often exempt from state and local taxes as well. This triple tax-exempt status makes them particularly attractive to investors in higher tax brackets.
And you mentioned safety earlier.
Yes, municipal bonds are generally considered safer than corporate bonds of similar quality because the issuing municipality has the power to levy taxes to meet its debt obligations. Corporations don't have that power. Of course, no bond is entirely risk-free.
Right. So understanding these basic risks, systematic versus non-systematic, and the nature of stocks versus bonds is really the starting point for making informed investment choices.
Absolutely. It's not about being scared of risk, but about understanding it, managing it through diversification and asset allocation, and aligning your investments with your financial goals and your personal comfort level with that risk.
Well said. Okay, moving from general investing, let's talk about investing in the future in a very specific way. Planning for education costs. This is a huge goal for many families.
Huge. And the costs keep rising. Fortunately, beyond just hoping for financial aid, there are many smart tax-advantaged ways families can save.
Let's dive into Section 529 plans, also called Qualified Tuition Programs or QTPs. These seem really popular.
They are, and for good reason. These are typically state-sponsored investment plans designed specifically for education savings. The big benefits are that your earnings grow tax-deferred, and then, crucially, qualified distributions used for education expenses are completely income tax-free at the federal level and often at the state level, too.
Tax-free growth and tax-free withdrawals for education. That sounds powerful. Are there different types?
Yes, two main types. First, prepaid tuition plans. With these, you essentially lock in future tuition rates at eligible public, and sometimes private, colleges or universities today. It's generally lower risk, focused specifically on tuition, and guarantees to keep pace with tuition inflation at those specific schools.
So you buy tomorrow's tuition at today's prices, basically.
Kind of, yeah. The second type, and maybe more common, are educational savings plans. Here, your contributions are invested in various portfolios, often mutual funds, similar to a 401k. The value fluctuates with market conditions, so there's investment risk, but also potential for greater growth. And importantly, the funds can generally be used at almost any accredited post-secondary institution, not just specific ones, and cover a wider range of expenses. You, as the owner, control the investments and withdrawals.
Okay, prepaid is like insurance against tuition hikes, savings is market-based growth potential. How do people typically fund these 529 plans?
Usually through gifts from parents, grandparents, other relatives, or friends. Contributions are considered gifts to the beneficiary. Now, there's an annual gift tax exclusion amount, $17,000 per donor per recipient in 2023. But 529 plans have a unique rule allowing for superfunding or front-loading. You can make a lump sum contribution of up to 5 times the annual exclusion amount at once. So, $85,000 for an individual, or $170,000 for a married couple splitting gifts in 2023, and elect to treat it as if it were made over 5 years, avoiding gift tax implications.
Wow, that allows for a big initial boost to the account.
It does. It's a great way to get significant funds working early.
What counts as a qualified higher education expense for those tax-free withdrawals?
It's pretty broad. It includes tuition, mandatory fees, books, supplies, and required equipment. It also covers reasonable room and board costs for students enrolled at least half-time. And recently, rules have expanded to allow limited use for K-12 tuition and even student loan repayment, though there are specifics to check there.
Okay, pretty flexible. Is there ever a time when earnings from a 529 distribution might be taxable?
Yes, there is. This happens if the total amount you withdraw in a year exceeds the beneficiary's adjusted qualified education expenses for that year.
Adjusted.
Right. Adjusted means you take the total qualified expenses and reduce them by any tax-free educational assistance the student received, like tax-free scholarships or grants. The remaining amount is the maximum you can withdraw tax-free from the 529. Let's use Joe's example. He has $9,000 in qualified expenses. He also received a $6,000 tax-free scholarship. So his adjusted qualified expenses are only $3,000, not $9K, $6K.
Okay.
Now, let's say his parents withdraw $5,000 from his 529 plan. Since the withdrawal, $5 is more than his adjusted expenses, 3DK, a portion of the earnings in that withdrawal will be taxable. You have to figure out the earnings ratio of the account and apply that ratio to the excess withdrawal amount, $2 in this case. Let's say his $5,000 withdrawal included $1,000 of earnings. About $400 of those earnings, $2K excess 5K total withdrawal, would be taxable income.
Okay, that's a bit complex, but the key is withdrawals can't exceed expenses after scholarships. What about penalties?
Yes, the taxable portion of a non-qualified distribution is also generally subject to a 10% penalty tax. However, there are exceptions to the penalty, though not the tax, for things like the beneficiary's death or disability, or if the excess withdrawal is due to receiving tax-free scholarships.
Got it. So 529s are powerful, but watch those withdrawal rules. What about Coverdell education savings accounts? Are they similar?
They share the goal of tax-advantaged education savings, but they have some key differences. Contributions to Coverdells are not deductible. The maximum annual contribution is much lower, only $2,000 per beneficiary, the student, per year, across all Coverdells set up for them.
Only $2,000 total.
Yes, total per child, regardless of how many people contribute. And contributions must generally stop when the beneficiary turns 18. There are also income phase-outs for the contributors. If your MAGI is too high, you might not be eligible to contribute.
So lower limits and income restrictions. What are the benefits?
Like 529s, earnings accumulate tax-free. Distributions are tax-free if used for qualified education expenses. A key difference here is that Coverdell funds can be used tax-free for qualified expenses from kindergarten through 12th grade, as well as for higher education. 529s are primarily for higher ed, though recent rules allow some K-12 tuition use.
Okay, K-12 flexibility is a plus. What if there's money left over?
If distributions exceed qualified expenses, the earnings portion is taxable and subject to the 10% penalty. However, a nice feature is that the account balance can generally be rolled over tax-free to another eligible family member's Coverdell or 529 plan if the original beneficiary doesn't use all the funds by age 30.
Good rollover option. Are there any other savings vehicles?
Well, briefly, U.S. Series E savings bonds purchased after 1989 can offer a tax benefit. If you redeem them and use the proceeds for qualified higher education expenses for yourself, your spouse, or a dependent, the interest earned might be tax-exempt. However, this benefit is also subject to fairly restrictive income phase-outs based on your MAGI when you redeem the bonds.
Okay, another option, but with income limits. Of course, many people rely on student loans.
Absolutely. Loans are a major funding source. But remember, unlike grants or scholarships, they have to be repaid, usually with interest. The main federal loan types are Stafford loans. These are for undergraduate and graduate students. They can be subsidized, meaning they are need-based, and the government pays the interest while the student is in school at least half-time and during grace periods. Or they can be unsubsidized, which are not need-based, and the student is responsible for all the accrued interest from day one.
So subsidized is better if you qualify.
Definitely. Then there are parent loans for undergraduate students, PLUS loans. These are federal loans available to parents of dependent undergraduate students. They're based on the parent's creditworthiness, not financial need, and the parent is the one legally responsible for repayment.
Okay. Is there any tax break related to student loans?
Yes, there is. You can generally deduct the amount of student loan interest you pay during the year up to a maximum of $2,500. This is an above-the-line deduction, which means you don't need to itemize to claim it.
$2,500 deduction. That helps. Are there limits?
Yes. Like many education benefits, the ability to take the student loan interest deduction is phased out based on your MZI. There are also rules about who is legally obligated to pay the loan and that the loan must have been used solely for qualified education expenses.
Got it. Phase-outs again. What about free money, like grants and scholarships?
This is the best kind of aid. Grants, like the Federal Pell Grant and the Federal Supplemental Educational Opportunity Grant, FSCOGG, are typically awarded based on financial need and do not have to be paid back. They reduce the amount you need to borrow or save.
Always maximize grants first.
Absolutely. Scholarships and fellowships are also generally free money, often awarded based on merit, talent, or other criteria. The key tax rule here is that they are generally tax-exempt if the student's pursuing a degree at an eligible institution, and the funds are used for qualified education expenses like tuition, fees, books, and required supplies.
What about room and board?
This is important. Scholarship or fellowship money used for expenses other than those core qualified expenses, such as room and board or travel, is generally considered taxable income to the student.
Ah, okay. So only the tuition fees books part is tax-free.
Generally, yes. There are also rules around tuition reductions provided by educational institutions, often for employees or their children, which can sometimes be tax exempt. But the specifics depend on whether it's for undergraduate or graduate study and the student's relationship to the institution.
Okay, lots of options there. So what does this all mean for someone planning for education?
It means you have a diverse toolkit. You can combine 529s, maybe covered Ls, savings bonds, responsible borrowing, and actively seeking out grants and scholarships. It's about creating a strategy that fits your family's financial situation, time horizon, and utilizes the available tax advantages to make that education goal more attainable.
Building a multi-pronged approach. Makes sense. Okay, now let's shift gears one more time. We've talked about building wealth through saving and investing, but just as important is protecting what you've built. Let's talk insurance and risk mitigation.
Absolutely critical, because life is unpredictable. Risk mitigation isn't about eliminating risk entirely that's often impossible or impractical. It's about effectively choosing methods to manage risk and, crucially, avoid catastrophic financial loss. Think of it as building a financial safety net or shield.
So how do we manage risk? What are the main methods?
There are generally four main ways to control or deal with risk. First is avoidance. This means, well, avoiding the activity that creates the risk. For example, if you're deeply concerned about the financial risks of coastal flooding, you might choose not to buy a beach house, thereby avoiding that specific risk.
Okay, just stay away from the risk.
Second is reduction. This involves taking steps to decrease the severity or likelihood of a loss if the risky event occurs. Installing a sophisticated security system in your home doesn't eliminate the risk of burglary, but it reduces the likelihood and potentially the severity. Same with fire sprinklers, reducing fire damage.
Makes sense. Reduce the impact.
Third is retention. This means you decide to absorb some or all of the potential loss yourself. This is often suitable for risks that are low in severity or frequency. For example, you might choose a higher deductible on your car insurance, effectively self-insuring or retaining the risk for smaller damages.
Okay, except the small stuff.
And fourth, the one most people think of with insurance is transfer. This involves shifting the financial consequences of a potential loss to another party, usually an insurance company. You pay a premium, and in exchange, the insurer agrees to cover specified losses if they occur.
So avoidance, reduction, retention, transfer. How do you decide which approach to use?
There's a useful framework, often shown as a matrix based on frequency, how often it might happen, and severity, how costly it would be. If a risk is both high frequency and high severity, the best strategy is often avoidance. Don't do it. If it's low frequency and low severity, retention often makes sense. Don't waste money insuring minor rare events. If it's high frequency but low severity, reduction, and maybe some retention, is key. Think shoplifting prevention in a store. And the sweet spot for insurance, or transfer, is typically for risks that are low frequency but high severity. Things like a major house fire, a serious car accident liability claim, or premature death. These are rare but financially devastating if they happen. That's where insurance provides the most value.
That's a really clear way to think about it. Low frequency, high severity, insure it. Okay, let's talk specific insurance, life insurance. What's its core purpose?
The primary purpose of life insurance is to protect against the economic loss created by someone's death, what actuaries call mortality risk. It's designed to provide financial support for dependents, pay off debts, like a mortgage, cover final expenses and funeral costs, or maybe fund future goals like college tuition if a primary earner passes away unexpectedly.
Okay. Replacing lost income, covering obligations. What are the main types?
Broadly, there are two main categories. First is term life insurance. You can think of this like renting insurance protection. It provides coverage for a specific limited period, term, which might be 10, 20, or 30 years.
So it covers you for a set time.
Exactly. If the insured person dies during that term, the policy pays out the death benefit. If they outlive the term, the coverage simply ends, unless renewed, often at much higher rates. Term insurance is typically less expensive initially, especially for younger, healthier individuals, and it's very suitable for covering temporary needs, like the years until children are independent or a mortgage is paid off.
Renting protection for a defined need. What's the alternative?
The alternative is permanent life insurance, often called whole life insurance, though there are other types like universal life, variable life. You think of this more like owning your insurance.
Owning? How so?
Permanent policies are designed to provide coverage for your entire lifetime,
as long as premiums are paid. Crucially, they also build cash value on a tax-deferred basis over time. This cash value is an asset that grows within the policy.
Cash value you can access.
Yes, you can typically borrow against the cash value or even surrender the policy for its cash value later on, though that might have tax consequences. The accumulated cash value can sometimes grow large enough to help pay the policy premiums itself. Permanent life insurance is generally more expensive than term, but it provides lifelong coverage and that savings component. It's often used for longer-term needs, like estate planning, especially by high-net-worth individuals looking to cover estate taxes.
Okay, term for temporary needs, permanent for lifelong coverage, and cash value. Got it. What about long-term care insurance? This seems increasingly important.
It really is, especially as people live longer. Long-term care, LTC insurance, provides benefits for individuals who need extended care due to chronic illness, disability, or cognitive impairment like Alzheimer's. Specifically, benefits usually trigger when someone is certified as being unable to perform a certain number, typically 2 of the 6 activities of daily living, ADLs, without substantial assistance.
What are those ADL?
They are basic self-care tasks: eating, bathing, dressing, toileting, getting on and off the toilet, transferring, moving in and out of a bed or chair, and continence. Or benefits can trigger due to severe cognitive impairment.
Okay, needing help with basic daily activities. Doesn't Medicare cover this kind of care?
This is a critical point of misunderstanding. Medicare provides very limited coverage for long-term care needs. Medicare primarily covers skilled nursing care following a qualifying hospital stay, and only for a short duration. It fully covers the first 20 days. Then, for days 21 through 100, there's a significant daily coinsurance payment required from the patient. And after day 100, Medicare pays nothing for that skilled nursing stay.
Only 100 days max, and only the first 20 are fully covered. Wow.
Yes. And perhaps even more importantly, Medicare generally requires that the patient's condition be improving and that the care be skilled care, not just custodial care, which is help with ADLs. It specifically excludes coverage for conditions like Alzheimer's or other chronic conditions where improvement isn't expected.
So if you need ongoing help with bathing and dressing due to Alzheimer's, Medicare won't cover that long term.
Generally, no. That's precisely where long-term care insurance is designed to step in. It essentially picks up where Medicare leaves off, providing benefits for those extended custodial care needs, whether at home, in assisted living, or a nursing facility that Medicare doesn't cover.
That's a huge gap it fills. Extremely important to understand those Medicare limits. Okay, one more policy type. Umbrella contracts. What are these?
Umbrella insurance policies provide an extra layer of liability protection. Liability means legal responsibility for causing injury to another person or damage to their property.
So it's not for your own injuries or property.
Correct. It's for claims against you by others. An umbrella policy sits over your existing liability coverage limits on your underlying policies, typically your homeowner's renter's insurance and your auto insurance.
How does that work?
Let's say your auto insurance has a liability limit of $300,000 per accident. You cause a serious accident, and the judgment against you is $1 million. Your auto policy pays its $300,000 limit. Your umbrella policy would then kick in to cover the remaining $700,000 up to the umbrella policy's limit, which might be $1 million, $2 million, or more.
Ah, so it covers catastrophic liability claims that exceed your standard limits.
Exactly. Insurance companies typically require you to maintain certain minimum liability limits on your underlying home and auto policies before they'll issue an umbrella policy.
Are there things umbrella policies don't cover?
Yes, important exclusions typically include your own injuries or damage to your own property. That's what your health, auto collision, or homeowner's insurance is for. Intentional or criminal acts you commit, and liability arising from business activities, which usually requires separate business liability insurance.
Got it. Extra protection for major lawsuits. So looking at insurance overall.
What's fascinating, as you said, is that insurance isn't just an expense line item. When used strategically, it's a vital part of a financial plan. It's a shield that provides peace of mind and protects your accumulated assets and future earnings from potentially devastating unexpected events, allowing you to pursue your financial goals with more confidence.
A strategic shield. I like that. Okay, let's start wrapping up our deep dive. We need to talk about measuring success and planning for the very end game, your legacy. First, how do we accurately understand how well our investments are really doing?
That's a great question. We often hear about return on investment, or ROI, right? Which is simply
Sales price cost. Cost. Tells you how much you gained relative to what you put in.
Yeah, simple percentage gain.
But ROI has limitations. It doesn't account for how long you held the investment, and crucially, it ignores the impact of taxes. A much more accurate measure, especially for taxable investments, is the after-tax rate of return, or ATRR.
After-tax rate of return, how's that calculated?
Simply put, it's your pre-tax ROI multiplied by 1 minus your marginal tax rate. ATRR equals ROI, one tax rate. It shows your return after accounting for the taxes you'll owe on the gain. Let's use Alice and Robert Peters' example. They have a high household income, over 500 tax rate. Let's say their combined marginal tax rate, federal, state, plus the net investment income tax, is around 44.8%. They make a $100,000 investment that grows to $125,000 a year later.
Okay, so their pre-tax ROI is 125K, $100 K equals 25%. Pretty good.
Looks great on the surface, but now let's calculate their ATRR. It's 25%, 1.448. That comes out to roughly 13.8%.
Wow, 25% pre-tax becomes less than 14% after tax. Taxes took almost half the gain.
Exactly. It dramatically illustrates how crucial taxes are in determining your actual spendable return. Comparing investments based on ATRR gives you a much clearer picture of which one truly benefits you more after Uncle Sam takes his share.
That's a really vital calculation to keep in mind. Okay, finally, let's talk about planning for legacy and avoiding common and often costly pitfalls.
Right. Estate planning. This isn't just for the super wealthy. It's for anyone who wants to ensure their assets go to the people or causes they care about, efficiently and according to their wishes. A major goal here is often avoiding probate.
Remind us what probate is again.
Probate is the formal, court-supervised legal process used to validate a will, if one exists, pay off the deceased person's debts, and distribute their remaining assets to the rightful heirs or beneficiaries. It can be time-consuming, expensive, legal fees, court costs, and it's generally a public process.
So avoiding it saves time, money, and maintains privacy. How critical are beneficiary designations here?
Incredibly critical and often misunderstood. Assets that have a named beneficiary designation, think life insurance policies, retirement accounts like 401ks and IRAs, annuities, sometimes bank accounts payable on death or POD, or brokerage accounts transferred on death or TOD, pass directly to that named beneficiary outside of the probate process and regardless of what your will says.
Regardless of the will.
Yes. The beneficiary designation overrides the will for that specific asset. A very common estate planning mistake is having outdated beneficiary designations that don't reflect your current wishes or life situation.
Okay, keeping those updated is paramount. What are some key tools and strategies people use to avoid probate and ensure assets transfer smoothly?
Several effective tools. First, a living trust, often a revocable living trust. This is a legal document you create during your lifetime. You then retitle certain assets, like your house, non-retirement investments, bank accounts, into the name of the trust. You typically act as the trustee while you're alive, managing the assets as usual. When you pass away, the successor trustee you named steps in and distributes the trust assets according to your instructions, completely bypassing probate court.
So the trust owns the assets, not you individually at death.
Exactly. Just note, it's generally not recommended to put tax-advantaged retirement accounts like IRAs or 401k directly into a living trust due to complex tax rules. Use beneficiary designations for those.
Okay. What else besides trusts?
Those automatic transfer mechanisms we mentioned. Payable on death, POD, designations for bank accounts and certificates of deposit, and transfer on death, TOD. Registrations for stocks, bonds, brokerage accounts, and sometimes even real estate deeds in certain states. These are simple forms you fill out with the financial institution or relevant authority, naming a beneficiary. The asset transfers automatically upon your death, outside probate.
Simple and effective.
Very. Then, of course, diligently using those beneficiary designations on every eligible account, life insurance, all retirement accounts, annuities. Review them regularly, especially after major life events like marriage, divorce, birth of a child, or death of a beneficiary.
Makes sense. Keep them current. Any other common methods?
One more is how you title property. Joint tenancy with righted survivorship, JTWROS. When property, like a house or a joint bank account, is owned this way, upon the death of one joint tenant, their share automatically passes directly to the surviving joint tenant. Again, completely outside of the will and probate. This is common for married couples.
Okay, so titling matters too.
It absolutely does. So if we connect this all back, these planning tools, living trusts, POD, TOD, beneficiary designations, joint tenancies, they're all about ensuring your hard-earned assets go to the right people or charities.
as quickly and efficiently as possible, minimizing costs, delays, and potential conflicts for your loved ones during what is already a difficult time.
It's really about leaving a legacy, like you said earlier, not leaving a legal and financial headache.
Precisely. Proactive planning makes all the difference.
And there you have it. Wow, what an incredible, comprehensive, deep dive into the world of personal financial planning. We've covered so much ground today, really, from building that retirement foundation with 401ks and IRAs, traditional versus Roth, understanding investment risks and basic assets, to strategically planning for education costs using 529s and other tools, choosing the right insurance life, LTC, umbrella to protect what you've built, and finally looking at after-tax returns and making sure your estate plan ensures your legacy goes where you intend, smoothly and efficiently.
And hopefully, you walk away from this not feeling overwhelmed, but rather equipped. You now have, I think, a really strong foundational understanding of these often complex financial concepts. This knowledge isn't just theory. It's genuinely designed to empower you, to help you ask better questions, feel more confident when talking to advisors, and ultimately make more informed decisions about your own financial future.
Absolutely. Knowledge is power, especially when it comes to your money. So as you, our listener, think about everything we've unpacked today, here's a question for you. What's one area of your personal finances, based on our conversation, that you're now maybe excited or at least motivated to deep dive into next for yourself? Perhaps it's finally checking those beneficiary designations on your retirement accounts. Maybe it's understanding your employer's 401k match better. Or perhaps sitting down to really figure out your current versus future tax rate situation to decide between traditional and Roth. Whatever it is, we encourage you to take that next step. Use this information. Thank you so much for joining us on this deep dive.